All right. Good morning, everybody. So today we have the VIX expiry. It's pretty much the biggest thing we have on the calendar today that we can rely on. Otherwise, Europe's up around 1%. Japan's down more than 0.75%. Small caps down. NASDAQ also, and then flat is the S&P and the Dow. Netflix says they would have beat. They just had some tax issues that whacked them pretty hard. And of course, the markets overreact. So that may be something to look into. Whatever their issues were with the taxes, it's behind them now. They finally resolved it. That one's been labeled account killer over the years because of some of the big moves it's seen before. Got some earnings coming up that may be worth looking into as well, just from the impact they can provide. And celebrity CEOs are always something you want to pay particular interest to. The things they say can move the market, even ones that you don't suspect, like Walmart. Walmart can move the markets when they report just because of the things they say during their report, not necessarily how well they did, but what their analysts see on spending trends and all of that. It can really move things. So, earnings, if you're just trading futures and you think that earnings aren't something that you need to be concerned about, you might want to readjust that perspective. Got some government people chipping their teeth. Christine Lagarde, a couple of U.S. Fed speakers, data out of Japan tonight. We got an auction at 1 o'clock. It's the 20-year. I happen to like that one quite a bit. And we've got crude oil inventories, including the Strategic Petroleum Reserve. So at 10:30 today, keep your eye out on that. We could see a little move in crude. So between the VIX expiry and the 20-year bond auction, I think that's as good as it's going to get. Unless we get some surprise headlines. But with this government shutdown, we're reaching levels that we haven't seen in a while for the duration. And according to all the sources, there's no impasse in sight. Neither side is even trying to come to terms. So, yeah, it's not looking like it's going to end anytime soon. And at some point, I would look for a downgrade in the bond ratings. Maybe like Fitch comes out or one of the others and kind of pokes the bear a little bit. If they give us the U.S. a credit downgrade because they can't get their act together, and we've seen it before. We've seen that when Fitch came out and gave a downgrade just because the two sides were fighting about something. Off the top of my head, I can't remember what it was about, but it was it ended in us getting downgraded. If that is to happen again, it will trigger a reaction, and the markets will not respond well to that. So that could be the wash that we're looking for. I've often said if the markets don't get some reward for the work that they put in, then they will wash the whole thing and start all over again. And generally that becomes a rush to the exit, hitting the bid and below the bid, with everybody chasing to see who can get out first and get this little micro flash crash to wake everybody up. I don't think we're quite there yet, but we will be once we get a Fitch downgrade, and that's all it'll take. the call wall rolled down significantly. I shared that picture. Generally, if they don't move in the call wall and the put wall are in the same spot, I don't take the picture and I just share the levels instead. But when we do get a move, then it's worth, sharing the picture and pointing out where the new level is. Let me see if I can scare that picture up so you know which one. I shared a lot of pictures today, so maybe it'll help. All right, this kind of a pink line, that's the call wall, and that's what rolled down. The put wall stayed the same, right? So, maybe it got a little ahead of itself here, but we've seen the put wall roll back a few days ago. Now the call wall has rolled down, and that limits our upside. Now we're at the volatility trigger. Below that, we've got the mid that we have marked out over here. In fact, let's just swap that over for a moment. I guess that ain't the mid. This mid here is this one here, right? And right now, this big day is the day that we're inside of. And we are inside day of this little itty bitty day from yesterday, right? So it's a really tight range. Markets are like anything else in nature. They don't like compression. If you compress it too much for too long, it'll explode. That's the way it goes. Nothing in nature likes to be contained. It's why they let water out at dams rather than just holding it up. It's like a pressure cooker, just more and more and more and more pressure. So at some point, this is going to move. If we were to turn on something like the RSI Laguerre, this would be stacking up in the 70s or 80s at this point, ready to go. So it's not directionally buoyant. It's not giving us an up or a down signal. It's just saying that this market's about to move. This is not the sort of situation that you want to run out of the money credit trades on, right? Like out of the money call credit spreads or out of the money put spreads. That's a really bad idea. I've always argued that it's a bad idea because you can't get far enough away from price, right? You want to make money on this potential move. Make a money that says if we go up, you get paid. We go down, you get paid. If we stay in the middle, that's where your risk is. Something like a straddle or a strangle, even some directional plays like a double diagonal, a double calendar, something like that. That way you get the width that you want. No iron condors or iron flies, broken wing flies, ratio flies, those would work. This is going to equate to a big move. This is also an NR2, so narrow range NR. We don't really hear much about NR days the way it used to be a much more popular trade strategy. But when it comes to analysis, even if you don't want to trade them, learning what the NR days are, how many there are, I mean, as many as you can count the days, but there are popular ones that have kind of lost focus over the years. So narrow range day, IX10, whatever you want to call it, all of these candles are inside of this one. So, we've been IX10 all along, but when you're inside day, inside a really big bar, who cares? There's no compression. It doesn't equate to big moves. It's just trash. So we've been, chopping around, playing in the garbage. But now were IX10 inside of this little bitty bar from yesterday. Today, we could stay here, maybe wick outside one end to the other. And if we have this same situation tomorrow, oh my goodness, what a Friday we will have. Right? If we make it through today and tomorrow, Friday is likely to have a candle like that big Friday back here. Not necessarily down, but that size of a move, up or down. One day at a time, though, GTFO, we got to get out of the box, and the box is the #1 concern at the moment. Now, I marked this big green bar. I marked the midpoint of that. Yesterday's candle, I'm not really interested in the midpoint of that. It's such a narrow range that the mid, to me, has no weight or value. Perhaps the close might carry a little significance, but I would rather rely on cog lines, pivot points, ADRs, and not the mid. Although, you know, that lines up pretty close to the mid anyways. It's too narrow of a range, and we've crossed through the mid too many times for it to even have any value. $64,000 in the overnight trading. That's acceptable levels. It's slightly more than the 50s that we would expect, but it's not 200 plus like we've seen in the last week or so. So I would consider it a little light compared to that. Well, I mean, you know, every time you go to work, we get a really good move. So we all thank you for your sacrifice. If you go to work on Friday, we're very likely going to have a really good move. Somebody's got to pay the piper. That's messed up, isn't it? We haven't really gone anywhere, so we don't have much edge when it comes to the ADRs. We would need an inside day breakout to get to either side, and my base case is that we can't stay here, right? It's the old phrase, I don't care where you go, you just can't stay here. Or, you know, markets want to move, we can't stay here. So it's very likely that we do not pull this off and that we do not get to stay in this range all day, let alone do it again tomorrow. While it's technically possible and price can do whatever it wants, it's really unlikely for this to happen. You know, just getting an overnight range that lasts this long is um, a standout significant signal. Having an entire 24-hour trading period and then another 12 on top of that, and we're still in this range, color me impressed. So base case, we're getting out of this box. That does not mean that the situation would be resolved, just that we could break up and say, you know, close above 6,800, or we could break down and maybe still close above 6,650. That we're not looking to necessarily get outside of this range. We're more talking about just getting out of that range. All right, we had two missed daily pivots in a row because we didn't hit the pivot yesterday either. So that was two missed daily pivots, and now we've hit our pivot. In fact, we've been hitting it all night long. One thing that really stands out about today's pivot is how narrow the channel is. Now, that's not as narrow as it could be. It could be so narrow you don't even see a yellow line, you just see a pink line there. That's how narrow it could be. But it is significantly narrow. When channels are wide, we don't anticipate that breakouts hold. And we expect that if we do get a breakout, it doesn't stick and price just comes back inside again. But when it's a narrow channel, we anticipate that breakouts hold and that we actually keep the move and we continue to move in that direction. And keep in mind, these floor pivots and these channels, they don't make price do anything. It's not going to cause us to break out. And if we did break out, it wouldn't keep us broke out and it wouldn't make us move. These are not market drivers. They're just insight into our expectation of if we get a breakout, is it likely to continue or are we just going to come back in again? This says if we get a breakout today, we're likely to keep it and we're just going to go. Now, what would that look like? We had a breakout the other day, right? We had that Friday expansion. Then on Monday, we broke out of Friday's range and we continued to expand, even though it was a wide channel day. But that's a continuation of the breakout, what Monday did. It doesn't have to be higher. It doesn't have to be lower. It just says that if we break out of this range that we've been talking about, we're very likely going to stay out of this range and continue to go. My only issue with that logic is that this range is not natural. It is derived from the bumper around us. Maybe it's the VIX expiry that's doing it. Maybe it's something else. But we've got a lot of structure holding us in place. And if that structure is still here, how can we get through it, right? We have to remove the structure. That could be VIX expiration. It really could, right? We don't know. So VIX expiration is in 8 minutes. After that, it's game on. And at 1 o'clock, we could see the impact of bonds. Commodities technically could do it at 10:30 with crude, but I don't know. Crude hasn't had that sort of power in a long time. Don't get me wrong, crude can wake the market up, but we're not necessarily in that backdrop unless Russia is to do something or the Ukraine does something to Russia and affects reserve, right? It'd have to be something really big and we don't have anything. So we could speculate, but doubt it's going to be crude, right? So either VIX in 8 minutes or the 10-year at 1 o'clock, excuse me, the 20-year. It's one of those years. The guy auctions at 1. And if it's not either one of those, then what? The heck is going to move us? Japan? We've already heard everything we're going to hear today. So unless we get some surprise out of them, you can't anticipate surprises. We don't even know what the surprise is going to be. That leaves us sitting here looking at the box. There's a threat on this breakout worth considering, and it's the S&R lines. So S&R lines are derived based off of the math of the previous day's trading session. Yesterday was a very narrow range, and so our S&R levels are really close together. We've already hit R1, which opens up S2. S2 is just right down the road, right? It's like 30 points away. Is not very far at all. If we were looking at this after a really big expansion day, then things change significantly. Look at the width that we had all the way back here, right? And these really wide ranges after really big days. Okay. So it can get really big and that makes them worthless, and it can get really, really small and that makes them worthless. Most of the textbooks and education that I saw on using pivot points in trading and using the S&R lines, they don't really get into that context. They don't mention that, hey, if you're trying to trade an R1 to an S2 or vice versa, that you can get run right the hell over. They talk about selling options against the R3 or the S3, using those as levels, or even S2 and R2. On a day like this, you try something like that, you're going to get run over and your loss is going to be significant because those way out of the money options are risking like 4.5 to make half. That's some trash stuff, by the way. That's junk. It's a good way to blow your account up. So don't mess with this stuff today, right? No out of the money 0-day premium selling. Because if you're wrong today, it's very likely going to hurt really bad. You wouldn't be able to count your fingers. You'd have them blown off on a move like this. We are continuing with the classic P shape from earlier this week. This P shape will be more beneficial to us next week when we look back and say, oh, look, it was a P shape last week. Just like during this week, we looked back at last week at the classic D shape profile. Still, it needs to resolve. Looking at it from this time frame, it's a classic bull flag. My issue with that logic is we've been here too long. The flag is lasting longer than it should have, and this is starting to form a failed flag pattern. Now, we don't have the failure yet, but classic pattern failure is something that I like to trade. Typically, it's the bear flag failure that I like, but patterns form new patterns, right? Everything connects. So you can start out with something like a downtrend that turns into a bear flag that lasts too long, and then you end up with an uptrend, and that just forms a big old cup. Then you get your pullback, right? There's your handle, and then a new breakout. That's a flag to the upside. So there's your pull. Then you end up with a flag. Well, if that flag lasts too long, you end up with an inverse cup, and maybe you get a handle, maybe not. Then down we go. So this flag is lasting longer than it should have if it was just a classic flag. The argument behind that is when you have all that bullishness and you've made your move to the upside and we pull back, the pullback makes sense. People who enjoyed the run up are taking profit. But what we expect is that others who missed the run are now jumping in because, well, it pulled back and it's giving them a chance to get in, which should drive it higher. And it didn't. Instead, we're just staying here. So either we're not getting the new participants, or we're not getting enough of them, or their demand isn't strong enough. We're not getting that next leg, which leads to the failure part of this and the trip back down. I don't have a quantifiable level of how much is too much, but here's another example of the trend. I know those two candles are hard to see, but after a big move, if your flag is lasting nearly as long in length as the trip up was, right? If the flag is as big as the pole, it's just too big. And what happens? Flag failure. We flip over and run back down. This is exactly the kind of pattern, just a smaller version of it. There's the trend. There's the bull flag. Lasted too long. There's the failure. So there's your inverse cup and a handle, although that's a really weird handle. And then down we went, right? Patterns tie into patterns that tie into patterns. So I don't like how long we're sitting up here. And the longer we sit here, the more likely it is that it's going to go the other way. Just keep in mind, price can do whatever the hell it wants. It doesn't owe us anything. 10-day, 30-minute volume profile and TPO. We got the point of control of both of those starting to line up again. If we make a break to the upside, we got a speed bump at 6,800 still. We can see all that work from back here. And the concern is that we're not done with that up there. If we get up there, there's likely still a lot of work to be done. We don't know how much more liquidity is there, but it's very likely we didn't take it all off the board the last time we were there. So we're going to need to go up there hungry enough to absorb everything that's there plus some and continue to go, or we're just going to reject again and come back in. This gets us back into the idea that if they don't accomplish something, they'll just wash it. So how many times can we test 6,800 before they say screw it and they wash it? I don't know. But that's the concern. Now, we had a strong rejection the last time we got up into that 6,800, right? That was that really big down day. If we get up there and we reject again, but it's a much smaller rejection, maybe something of this caliber or this size, well, that'll be a good tell, right? That'll be a much better signal if we get to 6,800 and get this sort of pullback, or even something smaller than that, right? Maybe something of that size, something much smaller. That would be a good pullback. We want healthy looking responses to that 6,800. This point of control is going to move soon. Over the next 24 to 36 hours, we're going to wipe these candles out. Now, sure, we're hanging out here and we're putting in a lot of work, but as we can see, the work that we're putting in is a little wider than that area that we're looking at, right? So yeah, maybe this new range that we're developing here is going to be enough to pay the piper and keep it here. I have some doubt on that. I think for at least a day, maybe two, we could see it drop down somewhere below us and then get brought back up here because of the amount of time that we stayed here. So we got Monday with the P shape, yesterday with the D shape, all just stacking it up right here. We still have that VPOC 6792 cog line overhead. So if we make a run for 6,800, we got to get through that. And this morning, there's not a lot of insight into what we see here. Really thin on the lows. So we didn't land in like a big liquidity pool down here. Other than that, there's not much to see here yet. It's not really going to be all that insightful or helpful. Weekly expected move 6832 cog line on the upside. So if we do get this breakout, get to 6,800, then you've got 6,811 and 6,832. It's 92, aughts, 11s, 32. That'll be the stopping points on the way up. Otherwise, break the mid from Monday, get back to 6711 cog line, back down to 67, then 92, then the half, then 32. You get it. Right on back down again. Okay. We're still more than 2% above the 10-week. That's a good place to be. We're not more than like 3.5 or 4, so we're not overextended or overbought or anything like that, which isn't a surprise. We haven't done anything in 2 days. This is a correction. When markets have made big moves, they need to correct, and this was the big move. We needed to heal from that and digest. So we've been hanging out here all last week, and now we're just hanging out here this week. And if you remember, we talked about these wicks yesterday. And the concern was after closing way up here, is that maybe we just didn't get enough time to mean revert, and that yesterday we could fall back down and leave a really big wick behind. That was the concern, right? Well, we didn't do that. We didn't end up leaving one of these style of wicks and closing down here. So great. We've now worked through all of that liquidity that was holding us back. Yay. But we're still not going anywhere. And the concern is very likely we still have all of that to deal with. I know it doesn't seem like much, but we built like an IX10 back here and put in a lot of work. And it's all tied to that 6,800. Now, Adam Grimes has a pattern called a pre-consolidation breakout or pre-breakout consolidation. There you go. So if we was looking for a break above 6,800, stopping in front of that level, consolidating, healing, gathering up all of our resources for then a big pop and push above 6,800, that's absolutely possible. So, you know, all of this doesn't have to tie into a bearish outcome at the end. And we're still above the 10-day. A 0.5% is a good place to be. We're not, you know, like 1.5, 2.0, 2.5. We're not anything like that. So we're not overbought. We're not overextended. That's not a surprise either because we haven't done anything. We're just in a good, healthy place to be. Right? It's like autopilot or cruise control on the interstate. Everything's good. No worries here. All right, so looking at what's down this morning, we got gold miners, Bitcoin, uranium. The Mag 7 up volume is down. Metals and mining, uranium again, China, quantum, chips, China, nat gas, quantum. All the good stuff is down today. Looking at what's up today, the Mag 7 down volume is up and bots are up. Energy, which ties in with that 1030 crude report. Healthcare, it's like a continuation of yesterday. And that's it. Now, Thinkorswim, you know, it doesn't do a fantastic job of pre-market stuff, right? It's just a little handicap. It tries to offer everything, and that means it's just kind of good at things. So you want to have another source for pre-market work. I use TrendSpider, but TradingView is another really good one. So we can see over here, crude is up the most, and then the VIX right behind it. But the VIX, you know, it's got that gap. So it always has that expiry gap. Then crude again, energy, healthcare, energy, emerging markets. And really, that's even too low to count. So it stops at energy. Energy and healthcare is all we got. On the one hand, that's not necessarily a bad thing, because that means if we do start to turn into a rally day, we would need to spot one of the triggers, whatever that happens to be. 0-day flows, a move in the dollar or treasuries, FX markets. It could be the Mag 7 going to the upside. Any of those could be a catalyst, and they'll be easy to spot, especially if we didn't have anything and then we suddenly have something. So I kind of like it from that point of view. Plus, we got to have the breakout, right? We don't have the breakout. So we don't necessarily need things like gold to go up, but we will need it to stop falling. That would be really helpful. If it does go up, that would be great, but it's not a requirement. Same with Bitcoin. Going up would really help, but just stop falling. Uranium, yeah, I mean, that ties back into the data centers and all that stuff. All right, so that looks pretty negative off the cuff. 12% of the S&P is down more than 0.5%. That's not really bearish. Excuse me, 12% of the S&P is up 0.5%. That's not really bullish. On the downside, 10% of the S&P is bearish. So 12 and 10, that's more sideways stuff. We're not bullish. We're not bearish. We got nothing. Looking at the NASDAQ, 20% of the NASDAQ is down 0.5% or more. That's a little bearish. Not enough. And 15% of the NASDAQ is up 0.5% or more. And again, that's not enough. So it should be really easy to see if we start getting the flows that can give us a breakout rally day. And that's the kind of flows you're going to be wanting to look for. We got to get out of the box and we got to keep it. So I would focus on not just yesterday's range, but all of this. Although I guess yesterday covers it. I was saying, make sure you get Monday in this topping pattern, but Monday is inside of Tuesday. So this section, it's fine. It's all right there. This is what you got to get out of. Now, with that in mind, the concern is a 111 reversal, right? That we end up with this IX10 that extends into Friday. That's the concern. So when we get to the edges, we have to do better than the 1, 2, 3, 6. On the upside, that basically puts us at 6,800. You got to get above that and keep it. To the downside, it's 6,750. Got to get below that and keep it. If we don't, we're just going to come right back up inside this box again, or right back down if it's from the highs. So that's a very simple GTFO setup right there. I will be playing the reversals just because that's the play until it's not. Even a first touch should get me a good 5 to 7 points. And 5 to 7 points with 10 to 15 contracts, I don't, that's it. I'm done. I don't need a 50-point move. So I'll be playing the reversal on first touch. If it gets there and then we OCC, set the new levels, mark it out for the next expansion, and then run it from there. Easy enough, right? Keep your eye on the clock. Don't forget, we got auctions at 1. Everybody, be careful. Good day. I'll see y'all tomorrow.